Good afternoon, everyone. Welcome to our webinar, Navigating China's Ferrous Market 2025, Quarter 3 Developments and Quarter 4 Prospects, brought to you by MySteel. My name is Bella Wang, and I'll be hosting today's webinar. Thank you for your support and participation. Today's webinar will feature 5 expert analysts from MySteel who will share their insights on China's ferrous market. The webinar will last approximately 1.5 hours, including a Q&A session at the end. Some of you have already submitted questions, which we will address during the presentation and the Q&A session. And if you have any question during the webinar, please feel free to type them in using the Q&A icon at the bottom of your screen. Now let's begin with our first speaker, Vivian Yang, Head of Editorial and Steel Analyst at MySteel. Vivian is a former seasoned media professional now specializing in market intelligence for bulk commodities. With in-depth expertise in China's ferrous metal sector, Vivian will share her expert insights on how China's steel market performed in the third quarter this year and what to expect in the fourth quarter. Now over to you, Vivian.
Okay, thank you, Bella. Let me share my screen first. Yes, all good, Bella?
Yes, it's clear.
Okay, thank you very much. So good afternoon, everyone. Welcome to our latest online session on China's ferrous market overview of Q3 and the outlook for Q4. So for this session, I'll mainly cover some key developments and hot button topics of China's steel market. Let's get started. Okay, first, let's take a look at China's steel price performance. As the top graph shows, China's steel price index has been fluctuating in a narrow band of about 300 yuan per ton, roughly range bound from 3350 to 3650 yuan per ton so far this year. The underwhelming price performance is largely due to lukewarm domestic demand for steel. But the steel price saw a marked rise in July, as the green left arrow shows. So this over 250 yuan price increment was mainly driven by anti-evolution policy expectations, as a top-level central government meeting in early July emphasized the need to regulate disorderly low price competition and promote the orderly exit of outdated capacity. So this signaled a new national level of anti-evolution policy direction and then fueled market expectations. However, the price rise was rather short-lived, as the right arrow shows that the steel price returned to a downtrend in August on seasonality, and then kept declining throughout September and October, weaker than expected demand recovery in the traditional peak season for steel consumption. But despite the softening of steel prices, the steel sector still saw a marked improvement in profits year to date. As the bottom graph shows, Chinese steel makers earned $3.7 billion in the first 9 months of this year, as against a huge loss of $4.8 billion in the same period last year. So the recovery of steel sector's profits is largely thanks to steeper price declines of steel-making raw materials, including iron ore, coke, coking coal, and ferrous scrap, than steel prices. Well, of course, despite the improvement in profits, the steel sector's overall profitabilities remain low this year, compared with the early years from 2016 to 2021, as the bottom graph suggests. Now let's take a look at the steel supply and the demand side. So during the first 9 months, China's crude steel output fell by 2.9% year-on-year, to 746 million tons. And in Q3 alone, steep output declines in July and September largely contributed to Q3's overall production drop, as the right-hand side graph shows. Behind the decline was both BF and EAF mills strengthened self-discipline on production, as well as policy-led production curbs, as the right-hand side graph suggests. First, from the policy perspective, environmental production curbs and national steel capacity controls continue to limit steel mills' production levels. The steel producing hub Tangshan in North China lasted a 2-week-long environmental curbs from late August to early September is an example. And the introduction of a 2-year action plan for the steel sector during 2025 to 2026 to further promote steel capacity reduction and the elimination of outdated capacity in September is another example. Meanwhile, steel mills have also been strengthening self-discipline in production control since Q2, mainly responding to the national call to resist against the anti-evolution competition and tepid domestic demand for steel. Speaking of steel demand, let's take a close look at this side. So during the first 3 quarters, China's apparent consumption of crude steel declined 5.7% year-on-year to 647 million tons. As we mentioned in the previous page, the steel production decline during the same period was 2.9%. So we can see that the decline in steel consumption was significantly larger than steel production. This showed that steel supply and demand imbalance has been persisting. And my steel surveys on this page suggest the same pattern. So the left-hand side graph shows that China's consumption of 5 major steel products, including rebar, HRC, CRC, media and heavy plate, and the wire rod, fell for most of the months by now, compared with the previous year. And the right-hand side graph also indicates such supply and demand mismatch persists. With the country's total stocks of the same 5 steel products keeping piling up since late June to now. So the inventory accumulation and actually accelerated in Q3 in particular, and put more downward pressure on steel prices. Well, actually, the high inventory level and weak domestic demand are now the key challenges facing the entire steel sector in the current quarter. Speaking of sluggish domestic demand, without any doubt, the real estate market remains the major drag on Chinese steel consumption. As the key indicators of the top table show, the property market stays on the downturn and shows little immediate recovery. So over more than 400 supportive measures have been introduced and taken effect so far this year. Well, actually, it has been a common consensus that China's housing market is still bottoming out and requires greater policy support to stabilize the market and prevent it from further decline. We can also see that recent central government statements on stabilizing the real estate market have been focused on greater efforts, implying that stabilizing and halting the downturn remains the country's main policy direction. Repairing residents' balance sheets and the confidence is key, and more supportive measures are also expected to be rolled out. What's also worth mentioning is that the latest fourth plenary session of the 20th CPC Central Meeting held last week once again emphasized the promotion of high-quality development of the real estate market. So the property sector will continue the ongoing structural adjustment and will focus on new development models in the 15th five-year plan period. For example, good housing, urban renewal, and the efficient use of existing housing and idle land will be the keys for the high-quality development of the real estate sector. But when it comes to steel use, demand for construction steel in particular will remain subdued. Because new starts continue to struggle, as we can see from the top table that, as I highlighted, newly launched projects still recorded a double-digit decline during the first 3 quarters. On the other hand, the demand gap left by the weak property market has been partially offset by the infrastructure sector. China's issuance of special purpose bond increased by 2.6% year-on-year to $117 billion by the end of September. This is mainly to support fiscal policy goals amid the ongoing economic challenges at China's domestic market. But apart from investing in existing and new infrastructure projects, the use of this special purpose bonds has also expanded into new areas, such as debt refinancing and clearing government arrears to enterprises. And what's more, the issuance of new special purpose bonds may slow down in Q4, as this year's total quota has been issued by nearly 84% during the first 3 quarters. So although steel use from infrastructure has partially offset the drag from the property sector, its contribution to overall steel demand growth will be very limited or marginal. Okay, let's look at the manufacturing sector. So this sector has undoubtedly become the main driver of steel demand in recent years. As all the tables on this page show, all major manufacturing subsectors, including automobile, white goods, shipbuilding, and construction machinery, all maintained a steady growth in the first 3 quarters, largely thanks to China's pro-consumption policies and other stimulus to expand domestic demand. This increased steel use in the manufacturing sector is largely against the backdrop of the two renewals policy to promote large-scale equipment upgrades and the trading programs for consumer goods, as well as the surge in rushed exports amid tariff uncertainties this year. Among all these subsectors, automobile performed the best. So this sector's year-on-year production and the sales have maintained over 10% growth for 5 consecutive months by now. And according to China Association of Automobile Manufacturers' latest forecast, the country's total vehicle sales are expected to increase by 4.7% year-on-year to reach 32.9 million units this year. And among this, sales of new energy vehicles are expected to near 16 million units, surging over 24% from the previous year. So on the whole, steel demand from manufacturing industry will remain elevated in recent years as the industry's steel consumption has yet to peak. Okay, we've talked about China's domestic steel demand performance, and now let's see the overseas demand for Chinese steel products. China's finished steel exports maintained very surprisingly strong momentum during the first 9 months, with the total volume rising 9.2% year-on-year to near 88 million tons, as the left-hand side graph shows. And for Q3 alone, September's export volume exceeded 10 million tons again, and became the second highest single month volume so far this year. So such strong exports are actually driven by a few sectors, including the price advantage of Chinese steel products, as the right-hand side graph shows, and the subdued domestic demand that we talked about, and relatively firm demand for steel in Asia. As the bottom table shows, that among the top 10 destinations for China's steel exports in the first 3 quarters, 9 countries were centered in Asia. Of course, another major factor behind the high export volume is the fact that Chinese steel exporters have accelerated their shipments because of the tariff concerns and restrictions throughout this year. And of all exported steel products, billet performed surprisingly strong, as the top table shows. During the first 3 quarters, the billet export volume actually more than doubled year-on-year to exceed 10 million tons. Well, actually, the total volume has already hit an all-time high. Behind the export surge is, of course, the price advantage of Chinese billets. Firm steel demand yet limited the rolling capacity of some emerging markets, and more importantly, tariff advantages that billets enjoyed, as there are near zero rates on billets among some countries by re-rolling the semi-product to bypass finished steel duties. And if we take a closer look at the top table, we can also see that apart from billets, construction steel products, including bars and rods, angles and sections, also saw marked double-digit growth in the first 9 months, indicating that global demand for construction and structural steel remains quite resilient. On the other hand, while exports of flat steel items, including HRC and CRC, declined, coated and galvanized plates and electrical steel sheets all performed quite well, underscoring the shift of the transformation of China's steel exports toward higher-end products. And let's move to the bottom table again. By destination or by country, we can see that Chinese steel exports traditional destinations, including Vietnam and South Korea, both recorded year-on-year declines as the 2 countries imposed anti-dumping and other safeguard measures on Chinese steel products. But some other countries in Southeast Asia, including Philippines, Thailand, Malaysia, and Indonesia, still maintain the year-on-year growth of Chinese steel exports. What's more, as an emerging market, the oil-rich countries, including UAE and Saudi Arabia in the Middle East, also saw increased steel tubes and pipes exports from China. Well, enough for the Chinese steel market overview. Let's now move on to the outlook. So for Q4, we estimate that both steel supply and the demand will remain subdued, while steel exports may stay elevated. So on the supply side, China's steel output may decline further in Q2 due to both policy-led production controls like environmental caps and the national capacity regulations that we have mentioned, as well as steel mill self-regulated production controls to match soft steel demand at domestic market and the declining profits According to MySteel's latest survey on 247 BF meals profitability, during this month, about 54% of these meals were profitable on average, down by around 6% from September. In other words, more than 45% of these BF meals were losing money on their steel sales. So we can see that mounting losses are expected to drive steel makers to reduce their production in the current quarter. And we estimate this year's total crude steel output to decline from last year's 1,005 million tons to sit around 990 to 980 million tons. And on the demand side, China's domestic demand will remain weak in Q4, with property sector remaining the major drag, while infrastructure and manufacturing sectors largely supporting the overall steel use. As for the China's apparent crude steel consumption for this year, we maintain our previous estimate with the volume to slightly decline from last year to sit around 890 million tons. On the export front, although Q4's volume may fall from decline from Q3, as steel export orders received in September had declined, as well as ongoing trade frictions are limiting export opportunities. The quarterly volume may stay elevated, and more significantly, this may bring this year's total steel exports to hit a new high, according to our latest estimate, as the top left-hand side graph shows. Because despite global headwinds, Chinese steel products will remain globally competitive in the long term. And growing demand from emerging markets, particularly in the Middle East, Africa, and some Southeast Asia countries, will partially offset the negative impacts brought by rising trade protectionism and other uncertainties globally. But the volume may decline next year, partly due to this year's high base, and also because with intensive anti-dumping investigations and tariff measures by certain countries against Chinese steel products starting to take effect. And so based on what we've just talked about, we expect Chinese steel prices to remain under pressure in Q4, especially amid the current high inventory level and the subdued domestic demand for steel. As for the price performance yearly, Chinese steel prices are forecast to stay on their downtrends throughout this year, together with the other major ferrous commodities, as this table shows. Specifically, rebar may remain the weakest, followed by HRC, and the media and heavy plates will see better price performance this year. And last but not least, let me take a moment to introduce one of our flagship products, Steel Daily. Steel Daily is a comprehensive steel market intelligence report that delivers daily PDF updates and an easy-to-use 13-month historical Excel, perfect for all market professionals who need accurate and timely market insights. Steel Daily combines key market indicators, the latest news, in-depth analysis, and the near-term outlooks for all steel categories, all backed by MySteel's extensive on-the-ground data collection. If you're a market professional, you won't want to miss this. So contact us to request your free trial. All right, that brings my presentation to an end today. Thank you all for your attention, and I hope you enjoyed it. If you have any inquiries or feedback, please feel free to contact me on LinkedIn. Over to you, Bella.
Thank you, Vivian, for your insightful presentation. Welcome our next speaker, Irene Zhuang, iron ore analyst at MySteel. Irene is instrumental in developing expertise in China's iron ore physical and derivatives markets and producing rigorous analysis through regularly published commentaries and reports. Irene will share her expert insights on China's iron ore market in the third quarter and the outlook for the fourth quarter. Now over to you, Irene.
Okay, thanks, Bella. Now I will share my screen first. Okay, good afternoon, everyone. This is Irene from MySteel Global. And now it's my turn to share with you a review of China's iron ore market in the past Q3 and the outlook for it in the Q4. Here is a gist of my speech today. First, I'll talk about the performance of the imported iron ore prices in the Q3 and the factors contributing to the price trend. And then I'll provide the outlook mainly from the perspective of supply and demand. In the end, a price forecast will be presented. So now let's get started. To put it simply, we saw a strong rebound in the imported iron ore prices in Q3. The market was down in Q2, but then the prices suddenly jumped in July and then kept climbing slowly in August. The prices spent most of the September hanging around at rather high levels before they slipped at the very end. So if you look at the top right chart, you can see that last year, the Q3 was a different story. The prices fell sharply and hit the year's low in September. So that's why we can see from the table that the year-on-year comparison turned positive from August onwards. But you should be reminded that the overall iron ore market was still weaker than before. So, in fact, by the end of September, the average price for 62% Australian fines was still 9% lower compared to 2024. So what drove this rebound in Q3? Well, I think the main force was improved market sentiment, which is largely thanks to China's anti-involution policy. This campaign, which targets overcapacity and the price wars, gave a boost to many industrial products, including steel and iron ore. And here I also list a few other key events that lifted the market mood and supported iron ore prices in the past quarter. For example, the launch of the MAC hydropower project in Tibet and the extended tariff truce between China and the United States. Also, when the production curbs in North China were lifted after Beijing's military parade in early September, it also raised market outlook for the iron ore demand. Now let's look at the fundamentals. Both supply and demand were pretty strong in Q3. On the demand side, even though the total hot metal output in China declined month on month, the daily average stayed above 2.4 million tons for most of the quarter. So as a result, China's hot metal production in Q3 was significantly higher than last year. And because of that, imported iron ore consumption at 2,047 Chinese mill we track also rose by 5% year on year during Q3. So why were those Chinese steelmakers so willing to keep their hot metal production high, even though it is the summer low season? Well, it is because most of them were still making good money. So from this bottom left chart, we can see over 55% of the 247 mills we track were profitable during the past quarter, and the ratio once peaked at nearly 66% at mid-August. That's a big improvement from last year's Q3 because at that time the ratio was largely below the 45% and even close to zero at some point. The enthusiasm for buying iron ore was also clear in the brisk trading at Chinese major ports. Our data shows that the monthly trading volume of imported ore at major ports kept growing during the Q3, and it hit a yearly high in September. A lot of that activity in September was mainly because mills were restocking actively ahead of China's National Day holiday. The mills typically build up their inventories, get through the long break, and all this buying helped keep the iron ore prices high for most of the month. And we can see the result of the restocking at the right chart. The inventories of imported iron ore held by the 247 mills we surveyed surged right before the end of September. The tonnage was up by 12% from August, and it is also 16% higher than a year ago. And now shifting to the supply side, China's domestic iron ore production did increase year on year in Q3, but that is mainly because last year's base was rather low due to the safety inspections disrupting the mining activities. So the truth is, Chinese miners cut their output in the first half of this year, and that weakness has continued into the second half. So in conclusion, from the official data, we can see that during the first 9 months, China's run-of-mine iron ore output was down by 3.8% year on year. And similarly, the output of concentrates from the 436 miners we track nationwide also fell by 4% on year. Since the production could hardly improve during the rest months, so we expect that the total domestic production in China will remain lower for the full year. While domestic supply tightened, the imported iron ore supply continued to grow in the third quarter with strong shipments. We can see from the left chart here, the global iron ore shipments in Q3 reached their highest quarterly level since 2021. It means that miners around the globe, especially those in Australia, were still working to make up for the disruption caused by the cyclones back in Q1. Notably, China's monthly iron ore imports hit a record high in September, and the total imports for the January and September between January and September were 917.7 million tons, almost flat compared to the last year. Specifically, imports from Australia rose by 1.7% on year, while those from Brazil were largely unchanged. Now, looking ahead to Q4, we expect the supply of imported iron ore to expand further. First, some major mines tend to ramp up their shipments to meet their annual targets, like Rio Tinto and Vale. And secondly, several new iron ore projects are set to boost global supply. And a key one is Guinea's giant Cemento project. The first shipment from the project has been moved up to just next month, and most of that ore is headed for China. So because of all this, we think China's iron ore imports this year could hit a new high, overtaking last year's 1.2 billion tons. While on the other hand, the demand for iron ore in China is expected to weaken in Q4. If you look at the top chart, you can see that China's hot metal production usually drops in the fourth quarter due to seasonal factors, and this year will likely be the same. And this is because the steel demand from end users in China usually slow down as cold weather hampers outdoor construction. Plus, the chart at the bottom right shows that the steel consumption this year has generally been weaker than previous 2 years, so we can expect a further decline this quarter. At the same time, steelmakers' profitability has been worsening since mid-August. For the first 3 quarters, more mills were profitable than last year, but the ratio started falling below the year-ago level in October. Our latest data shows that it's already down to 47.6% last week, a yearly low. So if the steel price remain weak in Q4, more mills will slip into the red, and this could result in more reduction in hot metal output, and iron ore demand will also face more pressure. Finally, a quick word on the port side inventory. The stocks of imported iron ore generally climbed higher during the past third quarter, rising by 1.7% on month by the end of September. As we mentioned before, the increase is mainly thanks to the strong imports during the third quarter. However, we can see from the bottom right chart that the overall port stock was still down 6% from the start of this year, and it is also 7% lower from the year-ago level. This is mainly because the arrivals during the first quarter was severely hit by the weather issues, while the discharge rates were mostly high so far this year. Now, looking at the Q4, we expect more cargoes will arrive at Chinese ports with growing supply around the globe, while the discharge volumes will shrink along with the lower hot metal production at mills. So the port side stocks are likely to accumulate this quarter. To wrap up, China's imported iron ore market is set to gradually shift from a tight balance in Q3 to an oversupply in Q4. We estimate that the average price for seaborne 62% Australian fines will be around $100 per dry metric tons in Q4, down from the 102 in Q3. The full-year average is forecast at 101, which is lower than the 109 we saw in 2024. We know that the big picture is the iron ore prices have been tracking lower in the recent years, and this downtrend is expected to continue in the coming years, mainly due to the global supply glut. And that is all for my presentation today. So thank you for listening. If you want to learn more about China's iron ore market, you can subscribe to our reports. For example, the Raw Material Daily can provide you the latest news and data on the steelmaking materials, and some other weekly reports are also available, like the narratives and the numbers weekly. For the samples of this report, you can contact our account managers. So that's all for today, for my part.
Thank you, Irene, for your very clear sharing about China's iron ore market. And now let's welcome our next speaker, Tammy Yang. Tammy is a coal and coke analyst at MySteel, with 10 years of experience focused on China's coking coal, thermal coal, met coke, and global market trends. And she joined MySteel in 2023, where she leverages her deep industry knowledge to support market intelligence. And for today's session, she will walk us through the shift in China's coal and coke markets from oversupply to shortage concerns. Now over to you, Tammy.
Okay, thank you, Bella. I'll share my screen. Okay, good afternoon, everyone. I am Tammy, coal and coke analyst from MySteel Global. So with coal and coke markets attracting much attention this year, let's just take a look at what has happened. I'll mainly focus on the following three parts. The key factors steering the market reversal in the third quarter, a look at the fundamental shifts behind the sentiment shares, and also what to expect for coal and coke markets in the fourth quarter. Firstly, in the two charts on China's total coal supply here, separately for the first 9 months this year and 2024, I believe a decline in July this year is quite clear here. China's overall coal supply has moderated to 417 million tons in July, lower by 8.2% from the average level during the September last year to June this year, which was deemed as an oversupply period. And if you look at the chart on the right side, we'll find the coal supply started surging quickly from September last year, with readings thereafter staying at historical high levels, which basically explain the persistent price drops in H1 this year. And a little bit background here, Chinese authorities restricted outbound coal shipments from its Ganjimoto border crossing, which is a main gateway for Mongolian coal exports to China, had initially caused a stock accumulation in last August, and later a snowball effect became greater, with Chinese trading firms at the port striving to meet their annual importing goals. So in the following months, through the first half of this year, a softening downstream demand further deepened this oversupply situation. In fact, China had adopted restrictive measures on coal imports from all sources from February this year, mainly by tightening quality controls of imported coal. But apparently, its effect had been offset by Chinese miners' higher operations, as they were eager to improve their poor profitable status by lifting production, since the price collapse seemed unlikely to come to an end. In the chart on the left, we could see that the coal imports decreased from February, but yes, here. But the overall supply didn't follow the same trend, with domestic output hovering high until clear shift from July. And also here's an overview of coking coal inventories in China based on MySteel survey data to give a clearer comparison. As of late October this year, China's overall coking coal stocks nearly declined by 10% on year to reach 34.6 million tons, while among the total, the drop on the supply side hit an impressive 24%, mainly driven by a 33.8% fall in seaport stocks and a 34.8% fall in China-Mongolian border ports. But if we look at the chart on the right side, it's pretty clear that the figures all stood quite high, basically reaching their historical highs. So what had steered the market to this favorable turn? Actually, many rumors, policies, and incidents emerged this year, with most of them involving supply side and adding to supports to the market. From May to June, increased mine accidents had firstly sparked this concern, with market players expecting authorities to tighten safety checks and coal supplies to experience a contraction. And early June saw multiple rumors spreading in the market, including the first one, step down of previous Mongolian premier, raised the concerns that the cross-border Gansu-Model Railway project will be put in limbo and coal exports from Mongolian would drop. And second, China's new mineral resources law will lead to shutdown of many small coal mines, and the stricter environmental and safety requirements would elevate costs. And the third, Mongolia may raise mineral resource tax for coal by 20%. And later in July, higher expectations for anti-involution policy continued fanning bullish sentiment, and an official document mandating overproduction investigations and 8 major coal provinces and regions just marked a key turning point of the market, giving a formal push to coal prices. And later factors like some Shanxi coal mines implementation of 276 workday, floods in North China, mine stoppages around the Beijing military parade continued cementing the market strength. We can find that the changes of the coal supply or just the outlook had played a key role of steering the market direction entering the second half year. Even in October, coal supply remained in volatility with some mines production disrupted by safety checks, and also most open cast mines in Wuhai and Qipanjing halted amid environmental checks, and Mongolians' political turmoil, chopping coal shipments to China's Gansu-Model. The rapid sentiment lift due to these factors had sent futures prices to hit the limit up for several times during the past months, with brisk speculative activities also boosting spot coal trading. And also there were positive signs from the demand side, since mills' hot melt output had remained about 2.4 million tons per day despite wavering steel prices this year. So it's fair to say that the coal market had experienced a shift from a stubborn glut to a situation where at least the supply concerns grows. And we'll just take a look at the actual fundamentals. The 4 charts could basically give a big picture of supply-demand dynamics. So look at the left side, despite some fluctuations, coking coal and coke production generally slowed down compared with H1 this year and the same period last year, with authorities tightening safety and environmental checks. At the same time, all the profits among steelmakers and coke firms were still pressured by underperformance of these markets. Hot metal production and the surveyed 247 mills had surpassed the year-ago levels almost for each month this year, which indicated that their demand for coal and coke remained relatively good. So we could conclude that the coking coal market generally returned to a tight fundamental balance from previous oversupply, but it hasn't developed into a broad shortage, though some premium coal types fell short of needs. The exaggerated response in sentiment had also served as a catalyst to market upticks, contributing to quicker coal liquidity as well. And also thermal coal market rebound also supported the prices of some crossover coal prices. So look at the price chart on the right side. There were clear rebounds of both coking coal and met coke prices from July, drawing the price lines to gradually closer to the levels in the same period last year. Meanwhile, manufacturers have guided the Chinese coal import mix to change this year. Compared with last year, the figures for the first 9 months this year showed that the top 2 suppliers, Mongolian and Russian, are steadily lifting their shares in China's import market, reaching a combined 78.3%. taking advantage of gaps caused by the decline in US and the Australian shipments. Because China has imposed higher tariffs on US cargoes in response to the country's tariff hikes, the costlier US coal has become not attractive for Chinese buyers. And also Australian coal displayed low cost performance as well. So, but shipments from Canada increased as more long-term contracts were signed with Chinese end users this year. By looking at the imported coal price curves, we could find that Russian and Mongolian coal prices closely tracked changes of China's domestic coal prices, surging quickly in late July and stabilizing at high levels in August. But the price movements of Australian and Canadian cargoes presented less correlation due to their diverse markets. Well, overall, China's coking coal imports from all sources in the first 9 months this year declined by 6% on year to reach 83.53 million tons due to the country's import controls. But we've observed that imports in the third quarter started recovering from previous lows, and Chinese coal price surges has underscored the cost effectiveness of overseas cargoes, and also imported restrictions relaxed slightly. For the fourth quarter, we believe a tight balance will persist with stricter safety and environmental checks to further check domestic coal production, and a structural shortage will continue to lend support to premium coal prices. China's coal import structure will continue to adjust with dominant suppliers, Mongolian and Russian, taking larger shares, and the US left slice, attracting competition among others. But downside risks may loom sometime in the fourth quarter, with high Mongolian coal inflows threatening to break the domestic market balance. While for the coke market, the surplus pressures could remain due to the active production activities in the fourth quarter. And the met coke prices will closely track coal price adjustments, which respond faster to sentiment and fundamental changes. Well, that's all my sharing. And if you're interested to stay connected to market changes, please feel free to consider subscribing to my Coal and Coke Daily Report, which covers China's global hot topics of the day, providing comprehensive domestic and import price assessments for coke, coking coal, and thermal coal. Thank you all. Over to you, Bella.
Thank you, Tammy, for interesting sharing. We are now midway through, and our next speaker is Anxia Shi, our steel scrap analyst. With 5 years in the industry, she first focused on non-ferrous metals reporting. Since joining MySteel in 2022, she has been specializing in ferrous scrap market, providing expert analysis and insights. In today's sharing, she will break down the ferrous scrap market, a look back at the third quarter, and a look at the road ahead in the fourth quarter. Now over to you, Anxia.
Okay, thank you, Bella. Now let me share my screen first. Okay, good afternoon, everyone. Thanks for joining me today. I'm Anthea, and I will be walking you through China's steel scrap market performance in Q3 and sharing our outlook for the coming months. And today we will cover 3 main areas: the price trends, key market fundamentals, and the impact of recent policies on the scrap sector. First, let's look at the steel scrap price performance. In the third quarter, China's national average steel scrap price was lower by around 7% compared with the same period last year. But if we look more closely, from July to September, we can see that the scrap prices actually moved upward steadily, while the prices of finished steel products such as rebar and HRC were falling. So why did scrap go against the trend? In fact, there was no special reason. It really comes down to just two things: the tight supply and stronger demand. So we will dig into the details in the next part. First, let's look at the supply side. China's steel scrap generation hasn't grown much in recent months. The real estate market, which is still China's largest steel consumer, remained weak in the third quarter, which means the progress of new construction projects was dragging slow. And during July to September, China's newly started building projects was lower by a significant 17% compared with the same period last year. And with fewer new projects moving forward, demolition of old buildings also slowed. And our survey shows that in the third quarter, the total recycling volume of demolition steel scrap dropped by a significant 34% compared with the same quarter last year. And at the same time, the manufacturing sector, which is another key source of steel scrap, has showed signs of waning in the past few months as policy support weakens. China's central government in recent years introduced a package of trade-in policies which are applicable to a wide range of industrial products from small electronic devices to automotives, and the subsidies were very generous. So they had effectively boosted domestic consumption and freed more vehicles and home appliances for scrapping. However, these policies are being gradually phasing out as the subsidies are winding down faster than expected, and many regions have actually already halted vehicle trading subsidies, while home appliance programs are shifting to a lottery system. And this has increased consumer costs again and slowed consumption activity. And from this chart, we can see that China's recycling of end-of-life vehicle was strong early this year, but they had stalled since May. And in Q3, the 85 scrapping companies we track collected around 102,000 ELVs, down by about 13% compared with the same period last year. And in addition to the market fluctuation, the adverse weather conditions, such as the scorching summer heat and heavy rainfalls, also disrupted the scrap processing and transportation in many regions, leading to the further tightening of scrap availability. Now let's move on to the imports. Back in June, China's Ministry of Ecology and Environment has issued new regulations on ferrous scrap imports, aligning with the national standards for recycling iron and steel materials. And the regulations officially came into effect on August the 1st, specifying that the ferrous scrap materials meeting the standards in this table can be imported without restrictions. And under the new rules, multiple categories of ferrous scrap can be declared under a single customs declaration, which wasn't allowed before, as long as they are clearly separated. However, the introduction of the new standards did not give any effective boost to China's steel scrap imports, as the stringent requirements for impurity levels remain unchanged. We can see here that the impurity content in the scrap materials cannot exceed 1%. And this means still only very high-grade scrap can be imported, and such high-grade materials are limited in the world, and they're very expensive. In fact, customs data shows that China's total ferrous scrap imports in Q3 did increase 6.5% on year, but that increase was almost entirely due to the stainless steel scrap, which leaped 76% on year to around 31,000 tons. China's stainless scrap demand is very strong this year, by the way. And for the common carbon steel scrap, the imports remained at low levels due to the wide price gap between steel scrap materials in domestic and overseas markets. As we can see from the line chart here, the spread between the price has expanded during this year. Japan is the largest steel scrap supplier to China, and the import price of HS grade scrap from Japan averaged around $346 per ton in September, higher by a large $54 per ton compared with the average spot price in East China's Jiangsu province. And with that kind of gap, it's just not economical for most mills to import. So we don't expect a major rebound in carbon steel scrap imports in the current quarter. Now let's move on to the demand side. First, let's look at the electric arc furnace mills. The EAF production in China has been fairly strong through the first 3 quarters this year. Especially in Q3, the average capacity utilization rate among the 90 independent EAF mills in China we track was around 55%, substantially higher by 15 percentage points compared with the same period last year. Of course, it is also partly due to the low base last year. And there are a few reasons why these mills kept output high. Aside from the conventional cost considerations, one of the key reasons is that the mills wanted to sustain their market share, so they have to proactively maintain production continuity, even though they suffered losses from time to time. Besides, many mini mills are in the data monitoring phase of ultra-low emission upgrades, and they're required to keep continuous production during this period. Otherwise, they cannot obtain government certification when they complete the low carbon transform. And also in some regions, local governments are encouraging mills to run to support economic activity. And given the robust production among EAF steelmakers, China's steel scrap demand expanded overall this year. In Q3, the combined steel scrap consumption by the 300 steelmakers under MySteel's tracking averaged around 558,000 tons per day, higher by a large 16.5% on year. Well, as for the blast furnace steelmakers, however, their scrap use was relatively softer. As this chart shows, in Q3, only for 24 days did steel scrap have a cost advantage over hot metal, and for the rest of the time, it was more expensive. And during these 3 months, the average cost of making steel using steel scrap among integrated mills in Jiangsu averaged 2,174 yuan per ton, higher by some 57 yuan per ton compared with using hot metal. The weak cost effectiveness has pressed BF steelmakers to reduce their use of steel scrap. During July to September, the steel scrap ratio used by integrated mills averaged 13.6%, down by half a point compared with the same period last year. And with scrap prices staying firm into October, that ratio could fall further in Q4. And now that brings us to the outlook for Q4. While we expect steel scrap consumption to pull back slightly in the coming months, as the production activity is likely to decline among both BF and EAF mills. So let's take a look at these profit charts. We can find that the margins are under pressure for both BF and EAF mills. Earlier, I mentioned that EAF mills would rather keep operating to maintain their market shares, even though they were suffering negative margins. But as the steel scrap prices show strong resilience, while steel prices weaken, the losses gradually became too hefty for them. Actually, the average losses on rebar sales incurred by EAF mills expanded steadily since the end of July and reached more than 150 yuan per ton by late October. The loss was the largest since July last year. So many steelmakers have started to rein in production entering this month, and by the end of October, the average capacity utilization rate of the 90 independent EAF mills we track was 52.3%. And on the BF side, we can see that the number of profitable mills in our sample is decreasing steadily. And by the end of October, it's only around 48% of the mills could make some profits. So it reached the lowest level since October last year. And with scrap still pricing above hot metal, there is little incentive for the BF mills to use more scrap. And more importantly, steel demand is unlikely to show any strong recovery in the fourth quarter, so steelmakers' demand for raw materials may stay subdued. And on the other hand, steel scrap supply may keep tightening in Q4. Beyond the weak real estate market and fading trading policies, another big issue is the heavy tax burden on scrap processors. Under the current system, the scrap yards in China are facing value-added tax, income tax, and sometimes even reverse invoicing taxes on behalf of individual raw scrap suppliers without enough supporting policies. So steel scrap industry is incurring too heavy tax burden, and as steel scrap prices kept dragging lower year by year, more and more processors are forced to close their businesses temporarily or even permanently, especially those that have not obtained certifications as qualified yards from the Ministry of Industry and Information Technology. And in this case, the ministry qualified scrapyards, which can enjoy a 30% tax rebate, are bearing effective tax rates at 12 to 17%. And those unqualified scrapyards are bearing the rate at 14 to 19%. And that's much higher than most other industries. As a result, the scrap inventories held by the 584 qualified scrapyards in China we track is remaining low, just around 952,000 tons at the end of October, down by 4% compared with last year. And imports won't be enough to fill the gap. So, steel scrap market is expected to maintain a tight balance in the fourth quarter, and after rising in Q3, the scrap prices are expected to pull back in Q4. The decline in steel scrap demand is expected to press steelmakers to reduce their purchase prices for scrap materials, but the tight supply will continue to provide firm support for the prices. Overall, the scrap prices will track lower while fluctuating within a narrow range. And that's all my sharing today. Thanks for your attention and engagement. If you have any further questions, feel free to contact me. Over to you, Bella.
Thank you, Anthea, for your comprehensive overview of the Chinese steel scrap markets. Now, last but not least, let's welcome our last speaker, Nancy Zheng. She is a steel analyst at MySteel, bringing more than 10 years of editorial experience in China's steel, ferroalloys, including silicon manganese and manganese ore, stainless steel, and Taiwan's steel markets since joining MySteel in 2014. She'll now take us through China's silicon manganese market, exploring its performance in the third quarter and what lies ahead for the fourth quarter. Over to you, Nancy.
Thank you, Bella. Let me share my screen first. Okay, good afternoon, everyone. This is Nancy from MySteel Global. Today, I'd like to share something about China's silicon manganese market. The content covers three parts: the price movement during the third quarter, changes in supply and demand, and the outlook for the fourth quarter. Now let's begin with the first part. China's silicon manganese prices moved down steadily in the first half year, while the prices recovered gradually since the start of July and touched a 4-month high in mid-August. Due to the better performance in silicon manganese and the ferrous futures markets, as sentiment improved with many favorable factors such as the start of the mega dam project in southwest China and the market expectations for policies to boost industrial growth and eliminate excessive competition. With the rapid rise in futures and spot prices, downstream steel mills had to accept the higher offers and buying prices of this ferroalloy tabled by Hebei Iron and Steel Group increased accordingly by 550 yuan per ton over July to August. China's silicon manganese market returned to the fundamentals later as sentiment cooled in the second half of August. Prices in the physical market retreated with the weakness in futures markets. Meanwhile, steelmakers cut their bidding prices of this ferroalloy given the decline in steel prices, which also put some pressure on the silicon manganese prices. China's manganese ore prices also increased since early July after the decline in the first 2 quarters due to the strong silicon manganese prices, better demand from smelters with their high-level alloy output, and the support of higher offers of overseas mines. As the world's top manganese ore mine, South 32 resumed the offers of Australian manganese ore for shipments since July. From the table, we can find that its prices of manganese ore, including South African manganese ore and Australian manganese ore, remained firm overall for shipments over July to November. South 32 stopped its offers of Australian manganese ore for shipments to China since May last year due to the damage at the ports at Groot Island caused by the tropical cyclone Megan in mid-March 2024. Operation at this joint venture has resumed in the second quarter of this year. However, domestic manganese ore prices also stayed under pressure since the second half of August, as alloy smelters refused to buy high-priced manganese ore given their less profit margins with the weakness in silicon manganese prices. Now let's move on to the second part, the changes in supply and demand. From the chart on the left, we can find that China's silicon manganese output hovered low in the second quarter when prices of this ferroalloy declined persistently, and many smelters slowed their production pace to ease the loss. And production increased fast over July to September as domestic smelters' profit margins improved, with the recovery in silicon manganese prices and the steady demand from steel mills. Smelters in northern China, including Inner Mongolia and Ningxia, kept their run rates high in the third quarter with their low-level cost. And the production in southwest China's Yunnan also grew rapidly over May to September as local smelters could enjoy competitive hydropower in the wet season to reduce their smelting cost. And total silicon manganese outputs marked a 13-month high in August. Some smelters in southwest China's Guizhou and Guangxi also resumed operation during the third quarter, driven by the better profits, while capacity utilization of the two regions still stayed at a relatively low level as local smelters' costs were higher than those in other regions. From the table, we can see from January to September, silicon manganese production in Inner Mongolia, Ningxia, and Yunnan posted on-year rise, while those of Guizhou and Guangxi declined on-year. As for manganese ore, China's manganese ore imports increased in the third quarter due to the increased shipments from overseas mines and better demand from downstream alloy smelters with their high-level manganese alloy output. From the chart on the left, we can find that China's manganese ore import volume posted on-year growth since the second quarter of this year, and the total volume for the first 9 months was 10% higher than last year. From the table, we can see that during the first 3 quarters, import volume from 3 major countries increased on year, only the tonnage from Gabon declined slightly. Manganese ore imports from Australia grew by 8% on year as South 32 resumed operation during the second quarter. With the persistent high-level imports, manganese ore stocks at China's major ports rebounded in April and stayed above 4 million tons in the third quarter. However, the current inventory level is much lower than the same period last year, which it has not put too much pressure on domestic manganese ore prices. For the demand side, China's silicon manganese demand remained firm during the third quarter as downstream steel producers kept their hot metal output high, and their consumption of this ferroalloy also stayed high, with the weekly average consumption being 5% higher than the average for the third quarter last year. From the chart on the right side, we can see that the bidding volume of silicon manganese tabled by Hebei Iron and Steel Group was much higher than last year, with the total buying volume for the third quarter soaring by 33% on year. Although China's silicon manganese output stayed high during the third quarter, firm demand was one key driver behind the recovery in the prices. Silicon manganese stocks held by Chinese smelters moved down in July as domestic smelters slowed their production base over June to July to ease their loss, and the stocks hovered low in August thanks to the steady demand from steel mills. However, smelters' in-plant stocks accumulated fast in late September, partly due to the pressure from the supply side with the persistent high output. Meanwhile, replenishment of downstream users failed to meet the market expectations, which also resulted in the rise in silicon manganese stocks. For this year, Chinese steel mills continued to keep their alloy stocks at a low level, and their average days of inventory availables hovered between 14 to 15 days. Steel mills could earn positive profits on finished steel sales, while many of them would like to keep their silicon manganese stocks low to reduce potential risks, given their limited profit margins. So how will China's silicon manganese market perform during the fourth quarter? For the supply side, production in northern China may stay high, as local smelters would like to maintain their run rates high, given their relatively low-level production costs, while the output in southern China may decrease over November to December due to the high electricity costs. Proportion of silicon manganese output in Inner Mongolia may increase further as more new capacity may be put into operation with the competitive smelting cost of local smelters. Silicon manganese production in Ningxia may keep stable in the fourth quarter, with local smelters' relatively low-level smelting costs. No additional capacity in this region is coming online till the end of next year. Some smelters in Guangxi have plans to resume operation in the fourth quarter, and the silicon manganese output in this region may be had to decline. However, production in Guizhou and Yunnan may slip during the coming 2 months as local smelters' power costs are likely to increase with the end of wet season. Of course, the growth in silicon manganese output may be constrained by the demand and prices, as smelters may delay the commission plans if demand and prices cannot meet the expectations. As for the demand, consumption of this ferroalloy from downstream steel mills kept stable overall in October with their steady production, while their hot metal output may slip slightly over November to December as steel demand may decline during the traditional off-season in winter. especially in northern China, where cold weather may hinder outdoor works. This means that their use of silicon manganese may decline accordingly. The high import cost of manganese ore with the higher offers of overseas mines may provide some support for China's silicon manganese prices from the cost side, while the support may be limited. So prices of silicon manganese in China are likely to stay under pressure till the end of this year, with the persistent imbalance between supply and demand. Meanwhile, steel mills may cut their buying prices of this ferroalloy further to reduce their production costs if their profit margins slip with the weakness in finished steel prices. That's the updates on the silicon manganese markets. For more information, please visit our website, mysteel.net. The website is a key intelligence platform for the ferrous sector. It stands out by collecting massive first-hand data from prices to production and has its own network of reporters. This allows it to provide traders and companies with trusted news, analysis, and a clear view of the market. Okay, that's all I have for today. Thank you. Over to you, Bella.
Thank you, Nancy, and sincere thank you to all our esteemed speakers for sharing such valuable and actionable insights with us today. We hope these discussions have given you a clearer, more strategic perspective on the market. So now, before we open the floor for the Q&A session, I do have one final piece of information that many of you have been asking about: how to access slides and video recording from today's session. So as this is our final Ferrous webinar of this year, we'd like to extend a special thank you to our existing subscribers. So you will receive all the webinar materials directly via email after the webinar. And for those of you who aren't MySteel subscribers yet, we have a special deal for you today. So just for $399, we grant you access to the presentation slides, video recording, plus a 1-month subscription to your choice of option 1 for access to our Ferrous channel on mysteel.net. Option B, to pick any one of our premium reports listed below. So normally you'd need to sign up for at least 1 year to get our service. We seldom offer short-term access like this, but today we're doing something differently. We are not offering one month trial, but formal subscription. That means you get all the data, all the tools, everything a paying annual member sees. Our website Ferrous channel gives you the complete picture covering the entire ferrous supply chain from raw materials to finished steel. You get around 25 original market stories daily, and you can use our built-in prices and indexes tools to create your own charts and track trends. All of this draws directly from our extensive first-hand data network across the market. On the other hand, if you are highly focused on one specific product, like iron ore, coking coal, rebar, or stainless steel, then choosing one of our premium reports is the way to go. It's a dedicated deep dive into that single market, providing the concentrated intelligence you need. So we offer steel daily, raw materials daily, coal and coke daily, MIOA narrative and numbers weekly, which spotlights iron ore, and ferroalloys market weekly, stainless weekly. And you are welcome to request our free sample reports on mysteel.net before making the decision. So we believe a 1-month access is the perfect way to experience the value of our insights can bring to your daily work. So if you're interested, please feel free to reach out to our team. We'll also be sending a dedicated follow-up email after webinar. All right, without further ado, let's begin our Q&A session. I'll now hand to you, Vivian.
Thank you, Bella. So I'll just start with the first question on steel. So I know many of you are keen to know the longer term impact of anti-evolution efforts on the Chinese steel sector. So I will answer this question briefly here. So first, we know that Chinese steel producers have been responding to the national call to resist against the anti-evolution competition by specifically controlling their production since this Q2. And that's why we come to see that the continuing decline in the country's total crude steel output. But steel mills strengthen the self-discipline on production control alone is not enough. The effectiveness of anti-evolution policy implementation is equally important. For example, as the latest effort by the governing body, China's Ministry of Industry and Information Technology, just released a stricter steel capacity swap action plan, as we reported on Monday. So the plan aims to curb China's total steel production capacity and optimize the industrial structure with tighter measures. As the plan is currently for public comment, that means these measures won't happen overnight, and it will take time to further rein in the country's total steel output. If the supply side contraction continues, it could help restore the supply and the demand balance and improve the steel market fundamentals. So in short, anti-evolution measures will benefit the steel sector in the medium and long term, but their actual impact still depends on effective implementation and remains to be seen. So all right, so that's for the first question. And the next question is about iron ore. So some audience asked how does China Mineral Resources Group involved in China's iron ore procurement, and how much, if any, has CMRG and BHP negotiation contributed to the recent iron ore price rally, and is it sustainable? So Irene, do you have any comments on this question?
Well, recently a dispute between the group and the BHP over the pricing and the settlement currency has sparkled the market rumors that China has banned certain iron ore shipments from BHP. Well, actually, these rumors did push iron ore prices up temporarily, but I don't think the increase is sustainable. For one thing, there is no solid evidence that the trade between the two parties has actually been suspended completely. Of course, actually, we have heard still have heard some transaction between Chinese mills and BHP. So even if secondly, even if a ban was in place, it's more like a negotiation technique to gain some leverage, rather than a broad ban, a broad trade restriction on a political level. So, and what's more, the BHP's products we heard to be banned by the group actually makes up only a small part of the overall iron ore trade in China's porcine market or seaborne market. So the alternatives like the products from other global mines like Rio Tinto are actually readily available. So there will be no short supply of such product in the market. So I think the price rally won't have enough strength to last. And so far, both sides have actually kept silence in public about their negotiations. The result of the talk is remain unclear. But we still know that we can still see from the negotiations that the China's Mineral Resource Group is helped to shift the balance of power between China's steel industry and the global mine giants. While the full impact of the dispute will probably become more clear next year when the new contracts are up for negotiations.
Hi,
Hey,
Vivian,
Vivian.
you are muted.
Sorry about that. Okay, so thank you, Irene. The following question is about coal. So our audience asked about the impacts of anti-evolution on China's coal supply. So Tammy, would you like to answer this question?
Okay, thank you, Vivian. Yes, China had introduced the anti-evolution concept earlier this year and repeatedly stressed its significance during many occasions. This policy orientation, which covers the meaning of phasing out outdated and surplus capacities and guiding markets back to healthy competition from disorderly low price world, is believed to bring profound influences to the embattled coal market. Since I've mentioned, the coal market has been heavily oversupplied since the fourth quarter last year. In July, an overproduction investigation was conducted in 8 major coal mining provinces, and one of the official documents about its results showed that a total of 93 coal mines in Inner Mongolia had operated beyond their licensed capacities during the past year and H1 this year, accounting for almost 1/3 of the region's operating coal mines. And those whose production exceeded 110% of their capacities were ordered for suspension and may face long-term monitoring. So far, the anti-evolution policy is at an early stage with investigation just completed. Market players believe that there will be more measures taken to prevent mines' excessive production in the future. Actually, its informal impact has actually emerged recently, with many mines avoiding to lift production beyond their capacities, which had kept the coal market in a relatively tight balance. And if any specific measures come into effect in the future, which could be a more flexible adjustment tool instead of a one-size-fits-all mandate, coal market will likely maintain this fundamental balance, I think, but it's less likely to cause prominent shortages. Hope this is helpful for the question. Okay, over to you, Vivian.
Okay, thank you, Tammy. And our last question is about ferrous scrap. So some audience would like to know the current share of EAF steel production in China, and is it expected to see a meaningful share increase by next year? So Anthea, what's your opinion?
Oh, thank you, Vivian. Actually, that's a key question for the future of our industry. And currently, we estimate that China's EAF steel share sits at a relatively low level, around 10%. And frankly, we do not anticipate a significant increase in this share by next year. And the single biggest constraint is the persistently tight supply of steel scrap. We forecast that China's total scrap supply will remain around 255 million tons for both 2025 and 2026, which is insufficient to fuel a major expansion of EAF production. And the tight supply leads to higher costs and larger losses, and in the end, there is a vicious circle. So, in fact, we expect that a meaningful increase for the EAF share may occur after maybe 2030. It is around that time when domestic steel scrap resource is finally expected to exceed 300 million tons. But it is important to note that Chinese government is actively encouraging EAF capacity expansion through various policies. Just last Friday, the Ministry of Industry and Information Technology published a new draft policy on capacity swap, after this scheme has been suspended for over a year, and it offers more lenient rules for electric furnaces compared to the conventional blast furnaces. And this policy could help accelerate EAF output growth to some extent in the coming years, even though the scrap supply will remain tight. And that's my answer. Thank you.
Okay, thank you, Anthea. And thank you all for your interesting and thought-provoking questions. And for those questions that we were unable to answer due to the time constraint, we will send you the reply by email. And over to you, Bella.
Thanks, Vivian. All right, that wraps up our session for today. So a quick reminder, if you are interested in the special $399 package, or you have any question about it, just reach out to us at inquiries@mysteel.com. Also, you're welcome to stay connected with us on LinkedIn and X, where daily updates on China's commodity markets are shared. Search for MySteel Global to follow and engage with us. Your thoughts and feedbacks are always welcome. Thank you again for joining us, and we look forward to seeing you again soon.